Most investors think they own AI winners, but I think many of them own the wrong AI stocks. Because just saying AI during the earnings call does not make a company an AI winner. For some companies, AI creates direct revenue. For others, AI creates margin pressure. For some companies, AI creates a massive capex problem. And for a few companies, AI could even attack the old business model. So the real question is not, is this company using AI? Everyone is using AI now. The real question is much more important. Does AI create revenue, margins, and free cash flow? Or does it create capex risk, pricing pressure, and disruption? So in this video, I'm going to rank Apple, Adobe, Salesforce, Snowflake, ServiceNow, Nvidia, Broadcom, TSMC, ASML, Meta, Palantir, Microsoft, Amazon, and Google. But I'm not going to start with Nvidia, because everybody knows Nvidia is an AI winner. The better question is, which AI stocks are investors getting wrong? And which companies looks like AI winners but may actually be riskier than people think? Before we rank the companies, we need one simple framework. I'm not ranking these companies by who is saying AI the most during the earnings call. I'm ranking them by one question. Can AI turn into long-term revenue, margins, and free cash flow? For some companies, AI creates direct demand. More AI means more chips, more cloud, more networking, more storage, and more infrastructure. For others, AI improves the core business. Better ads, better recommendations, better logistics, better workflows. But for some companies, AI creates risk. If AI makes workers more productive, maybe companies need fewer software seats. And if fewer seats are needed, the old SaaS pricing model can come under pressure. There is also a capex risk. Some companies are spending tens of billions of dollars on AI infrastructure. That can be great if the return is high. But if the return is not clear, free cash flow can get pressured. And one more thing is very important. AI can be real. AI can keep growing. But stocks can still crash if the cycle turns. So this is not an AI hype ranking. This is a risk-adjusted AI ranking. Now let's start with tier D. And the reason I start here is important. These are not bad companies, but they are the companies where AI creates the most confusion risk. And this is where investors can make mistakes. D tier does not mean these companies are dead. It means AI may help them, but it may also attack part of the business model. And that makes the AI story less clean. Let's start with Salesforce. On the surface, Salesforce should benefit from AI. Sales teams can use it, customer support teams can use it, marketing teams can use AI, and Agentforce can automate work. So the bull case is real. But here's the problem. Salesforce is still a traditional software company. A lot of business is based on users, seats, and subscriptions. And AI creates a big question for that model. If AI agents do more of the work, companies may need fewer human seats. And if fewer humans use the software, the old per-seat model becomes less powerful. This is the risk. Salesforce is trying to solve this with Agentforce and usage-based AI pricing. But investors need to watch one thing. Is AI creating new revenue, or it is just replacing the old revenue? The difference matters a lot. So Salesforce is not a fake AI company, but it has AI opportunity and AI disruption risk. That's why Salesforce goes into tier D. Now let's talk about Adobe. Adobe is one of the most controversial AI stocks. And I understand both sides. Adobe already owns the professional creative workflow, photos, videos, documents, design, and now Firefly. So if Adobe adds AI inside these workflows, it can make creators more productive. That could improve retention, and maybe Adobe can charge more over time. Adobe also has one very important advantage. Firefly was trained on licensed content and commercially safer content. That matters a lot for enterprises. Big companies are not only asking, can this AI tool create a nice image? They are asking, can we use this safely in commercial work? This is where Adobe may have an advantage, but the risk is also obvious. AI makes creative work cheaper. If image generation, video generation, logo design, and marketing assets become easier, Adobe's moat could weaken. Small businesses may use cheaper AI tools, casual creators may stop paying for expensive software, so Adobe has to prove that AI expands the market instead of commoditizing the product. The business is still very profitable, the valuation is much cheaper than before, but as an AI stock, the story is still mixed. That's why Adobe also goes into tier D. Now tier C is more interesting. These are not obvious AI losers. AI can help them, but I still need more proof before I can call them clear AI winners. Apple. Apple is one of the greatest business in the world. The brand is amazing, the ecosystem is strong, and the company generates enormous free cash flow. But this video is not about the best business, this is about the best AI stocks. And Apple's AI story is still not clear enough. The bull case is that Apple controls the device layer. More than a billion people use Apple devices. If AI becomes deeply integrated into the iPhone, Mac, iPad, Apple Watch and AirPods, Apple could benefit. On-device AI could become important, privacy could become important, and AI could drive a new upgrade cycle. But here's the problem. So far, Apple has not shown the same direct AI revenue acceleration as Nvidia, Microsoft, Amazon, Google, Meta, or Palantir. Apple may benefit from AI, but I still do not see a clear AI revenue engine. There is also one more risk. If AI systems become the new interface, Apple needs to make sure it still controls that interface. Because today, Apple controls the app layer through iOS. But if people start using AI agents to do everything, the operating system may become less visible. I'm not saying Apple is in trouble. Apple is still an incredible company. But as an AI stock, I need more proof. That's why Apple goes into tier C. Now let's talk about Snowflake. Snowflake has a very logical AI story. AI needs clean enterprise data, and Snowflake helps companies manage that data. Before AI can be useful inside a company, the data needs to be clean, organized, secure, and usable. That's where Snowflake fits. AI increases the value of enterprise data. So yes, AI could help Snowflake, but investors need to be careful. Snowflake still needs to prove that AI creates durable consumption growth. The competition is a real risk. Snowflake runs on top of AWS, Azure, and Google Cloud. But those same companies are also compete with Snowflake. AWS had Redshift, Google has BigQuery, and Microsoft has Fabric. So Snowflake's partners are also its competitors. And there is one more concern: stock-based compensation. Snowflake generates positive free cash flow, but a large part of that free cash flow is helped by adding back stock-based compensation. So free cash flow can look better than the real shareholder economics, because shareholders are still being diluted. So Snowflake has a good AI story, but it still needs proof. More AI consumption, better margins, better free cash flow per share, and lower stock-based compensation over time. That's why Snowflake goes into tier C. ServiceNow is very interesting because it sits in the middle of the AI debate. AI can make ServiceNow more valuable, but AI also can pressure the old SaaS model. ServiceNow is different from Salesforce because it's much deeper inside enterprise workflows. This is not a simple app someone can rebuild in 1 week. ServiceNow helps large companies manage workflows: IT, HR, customer support, security, internal processes. It's deeply embedded inside largest enterprises. It has workflows, approvals, permissions, integrations, and compliance. That creates switching costs. AI can also make ServiceNow more useful. AI agents can answer employees' questions, solve tickets, search across systems, and complete workflows. That's the bull case. ServiceNow could become the control tower for enterprise AI workflows. But the pricing risk is still real. If AI makes employees more productive, companies may need fewer seats. And if companies need fewer seats, seat-based software growth can slow down. ServiceNow is already moving toward more usage-based and value-based pricing. That's good, but investors still need to watch the transition. So ServiceNow is not an AI loser, but it's also not a clean AI winner yet. I have 2 videos on the channel about ServiceNow. One is a deep dive on the company, and second is I was planning to open a position in ServiceNow, but then I stopped after I found a few risks. You can find the link in the description below. ServiceNow is a bit tough. I was thinking for a long time, should it go to tier C or tier B? Let me know in the comments how would you rank ServiceNow, but I'm ranking currently at tier C. And now we get to the controversial tier. These companies are some of the clearest AI winners in the world, but I still do not put them at the top. Why? Because they are tied to the AI capex cycle. The businesses can be amazing, but the stock can still be dangerous. TSMC and ASML are critical parts of AI supply chain. Nvidia designs chips, Apple designs chips, Broadcom helps design custom chips, AMD designs chips, but someone still has to manufacture them. And for the most advanced chips, the company is usually TSMC. So if AI chip demand keep growing, TSMC benefits. It does not matter if the winning customer is Nvidia, AMD, Apple, Broadcom, or another chip designer. If advanced chips need to be manufactured, TSMC is very likely involved. ASML is different. ASML does not manufacture the chips. ASML sells the machines that can make advanced chips possible, especially EUV lithography machines. Without ASML, it's very hard to manufacture the most advanced semiconductors. So in simple words, Nvidia needs advanced chips, TSMC makes them, and ASML sells the machines that make them possible. These are clearly AI winners, but they are not risk-free. TSMC has geopolitical risk, ASML has export control risk, and both are tied to the semiconductor cycle. If customers overbuild capacity and then slow orders, growth can decelerate quickly. So TSMC goes into tier B, and ASML also goes into tier B. The next company is Broadcom. Broadcom may be one of the most underrated AI winners, and the reason is simple. One of Nvidia's biggest risks could become Broadcom's opportunity. When people think about AI chips, they think about Nvidia, but Broadcom benefits from the different part of the AI boom: custom AI chips, networking, connectivity, and the hidden infrastructure inside data centers. If hyperscalers want to reduce Nvidia dependence and build custom AI chips, Broadcom can benefit. So if the world buys more Nvidia GPUs, Nvidia wins. But if hyperscalers build more custom chips, Broadcom can also win. That's what makes Broadcom interesting. But there is a risk. Broadcom is still tied to AI infrastructure spending. If hyperscalers slow capex, Broadcom growth can slow too. There is also a customer concentration. A very few large customers matter a lot. So Broadcom is clearly an AI winner, but because it's tied to the capex cycle, it goes into B tier. Now let's talk about Nvidia. And this may surprise some people because Nvidia is probably the clearest AI winner in the market. If companies want to train large AI models, they need GPUs. If companies want to run AI models at scale, they need inference capacity. And Nvidia is positioned in both. Training is when you build a model. Inference is when people use the model. Every ChatGPT question, every Copilot request, every AI image, every AI agent action, that's the inference. That's why Nvidia has one of the highest AI business scores in the ranking. AI directly increases demand. Nvidia has pricing power. Margins are very strong, and Nvidia sells the infrastructure instead of just buying it. But here is the key point. Nvidia may be the best AI business in the world, but that does not automatically make it the best AI stock today. Nvidia is still a semiconductor company, and semiconductor stocks are cyclical. If hyperscalers spend aggressively for a few years, Nvidia can print unbelievable numbers. But if the capex cycle slows down, the stock could still crash hard. AI can keep growing, Nvidia can remain important, and the stock can still fall if expectations are too high. There are also other risks: export control, customer concentration, and custom silicon. Google has TPUs, Amazon has Trainium and Inferentia, Microsoft has Maya, Meta is building more custom infrastructure. So over time, the biggest customers will try to reduce the Nvidia tax. I'm not saying Nvidia is a bad company, not even close. It's one of the best companies in the world. But from the risk-adjusted perspective, I do not automatically put Nvidia in S tier. Clear AI winner, but more cyclical than most investors think. That's why Nvidia goes into tier B. Now we move to the companies where AI is clearly improving the core business. They are not risk-free, but the AI tailwind is very real. Meta. Meta is not selling AI like Nvidia. Meta is using AI to make its attention machine more profitable. Meta makes most of its money from ads. So the key question is, does AI improve ads? I think the answer is yes. AI can improve content ranking, AI can improve ad targeting, AI can help advertisers create better ads, AI can increase engagement across Facebook, Instagram, WhatsApp, Threads, and Messenger. Meta does not need to sell an AI subscription to win. If AI improves engagement by a few percent, that can already help huge. If AI improves ad conversion, advertisers may spend more. And Meta has massive distribution. Billions of people already use its products every day. There is still a risk. CapEx. Meta is spending a lot of AI infrastructure, and unlike Amazon, Microsoft, and Google, Meta does not have a public cloud business today. So Meta mostly uses AI internally. That can still be very valuable, but the payback is harder to measure. My personal bet is that Meta could eventually become something closer to a hyperscaler. Not today, maybe not next year, but if Meta overbuilds AI infrastructure and later has extra capacity, it could sell some compute or AI services to outside customers. That's not the base case, but this is interesting long-term option. So Meta goes into tier A, AI improves the core business, CapEx is the main risk. The next company is Palantir. Palantir may be the clearest software AI winner. This is not a company just adding a chatbot to an old product. Palantir helps governments and enterprises deploy AI in real operations. Most companies have messy data, disconnected systems, security concerns, compliance requirements, and they cannot just paste everything into the ChatGPT. Palantir helps solve that. It connects data, workflows, models, and decisions. That's why AIP is powerful. And the numbers are showing the AI story is real. Growth is reaccelerating, US commercial revenue is growing extremely fast, government demand is strong, and management keeps raising expectations. So the risk is not the AI story. The AI story is real. The risk is expectations. Yes, Palantir looks expensive on normal multiples, but if the company is growing this fast, with high margins and AI is clearly driving demand, maybe it's not as expensive as it looks at the first glance. I'm not saying valuation does not matter, it does, but you cannot value Palantir like a normal, mature software company. Palantir is one of the clearest AI winners in the stock market, but it's not low risk. Business impact, extremely positive. AI tailwind, very clear. Main risk, valuation and expectations. This is why Palantir goes into tier A. Now we finally get to tier S, and this is where ranking may surprise many people. Because my top group is not Nvidia. S tier is not simply the companies with the fastest AI revenue today. If that was the only question, Nvidia would probably be number one. This is a risk adjusted, and these companies have more than one way to win. They can sell AI infrastructure, they can improve existing products, they can use AI internally, they have distributions, they have customers, and they can fund innovations from existing businesses. That's why I put these companies at the top. Microsoft is a clear AI winner. It has Azure, Office, GitHub, security, Windows, LinkedIn, and Dynamics. So Microsoft can monetize AI in many ways. Azure benefits from AI infrastructure demand. Office benefits from Copilot. GitHub benefits from coding assistance. Security can become more valuable, and Microsoft already has enterprise trust. That distribution is a huge advantage. If Microsoft launches an AI product, it does not start from zero. It can sell into existing customer relationships, but there are also three risks: OpenAI dependency, Copilot quality, and AI capex. OpenAI has been a major part of Microsoft's AI story. OpenAI demand supports Azure, which is good, but also means Microsoft may look more independent than it really is. Part of Microsoft's AI demand is tied to OpenAI, so investors should not treat all AI backlog as normal enterprise demand. GitHub Copilot is useful, but comparing to companies like Anthropic, some Microsoft AI products do not feel as impressive. And third, CapEx is massive. AI infrastructure is expensive, and investors need to see whether AI revenue grows fast enough to justify the spend. But here's the positive side. Microsoft is now cheaper compared to own history. And if Azure is still strong, Microsoft Cloud is still growing, and the valuation is below its historical premiums, risk-reward becomes more interesting. So Microsoft is not a perfect AI story, but it still belongs to tier S because it has many ways to win. Cloud, productivity, developer tools, security, enterprise distribution. That is why Microsoft goes into tier S. Amazon. Amazon is not just e-commerce. That's the biggest mistake investors make with Amazon. Yes, Amazon has online stores, Prime, logistics, but the AI engine inside Amazon is AWS. AWS is the biggest cloud platform in the world, And if AI demand keeps growing, AWS should benefit. If companies need compute, storage, databases, security, and networking, Amazon can offer all of that. Amazon has three major AI angles. AWS can sell AI infrastructure, advertising can become more efficient, and logistics can become more automated. AI can also improve robotics, search, pricing, recommendations, and customer support. So Amazon has an external AI revenue and internal efficiency benefits. That's powerful. The main risk is CapEx. AWS needs massive investment. AI infrastructure is expensive. So free cash flow can be pressured before the payoff becomes obvious. That's why Amazon can look strange on valuation. Price to free cash flow may look expensive during the CapEx cycle, but the price to operating cash flow can look much more reasonable. One more thing is important. AI can copy digital products, but AI cannot easily copy warehouses, trucks, robots, sellers, fulfillment, and customer trust. So Amazon belongs in tier S. AWS, advertising, logistics, robotics, e-commerce, massive distribution, many ways to win. Amazon goes into tier S. Alphabet. Google may be the most balanced AI winner in this list. I know that sounds strange because for a long time investors were worried about AI would destroy Google search. That risk is real. If people stop using traditional search and start using ChatGPT, Gemini, or AI agents, Google search economics could change. But Google is not just defending against AI. Google is also one of the biggest AI winners. Google has Gemini, YouTube, Google Cloud, Android, TPUs, search, and massive distribution. Google is not just buying Nvidia chips like everyone else. Google has its own custom silicon that can control more of the AI stack. Google Cloud is also benefiting from AI infrastructure demand. Google is becoming more than an advertising company trying to protect search. It's becoming a full AI infrastructure and AI platform company. But the biggest advantage Google has compared to OpenAI is simple. Google is already profitable. Google has old cash cow businesses that fund the next generation of innovation. Search, YouTube, ads, Android. These businesses generate enormous profits, and Google can use that money to fund Gemini, TPUs, Google Cloud, and AI research. OpenAI does not have the same advantage. OpenAI needs huge amount of outside capital to keep scaling. Google can fund much of this from its own business. That's a massive advantage. The main risk is still search disruption. If AI answers reduce paid clicks, Google may need to change search monetization. But Google also has massive distribution. Billions of people use search, YouTube, Gmail, Maps, Android, and Chrome. So if Google integrates AI well, it can defend and maybe expand the ecosystem. That's why Alphabet is in tier S. Cloud, custom chips, data, YouTube, Android, search cash flow, and one of the strongest AI funding engines in the world. For me, Alphabet may be the most balanced AI winner. Even though the valuation is on the high end right now, Alphabet goes into tier S. Let me know in the comments if you agree with this ranking. Which company would you move higher? Which company would you move lower? And which AI stack do you think most investors are getting completely wrong? Thank you so much for watching. If you found this video useful, consider subscribing to the channel, and I will see you in the next one.